Can you hear me? Can you hear me? Hello. Yeah. Uh, Are you able to see my screen? Oh. Uh, Good morning, everyone. Today we are going to discuss about financial analysis. We are going to discuss about financial analysis. So, financial analysis is the process of evaluating the financial performance and the financial position to understand the business prospects and in terms of profitability and the financial position of the company. So, in the process of financial analysis, we will analyze the profitability and position of the company based on the information given in the financial statements. Normally, financial analysis is broadly classified into two categories. One is fundamental analysis and another is technical analysis. Both are related to the valuation of company. In case of fundamental analysis, we'll do both qualitative and quantitative analysis based on the historical data available in the financial statements and information given in the company documents. So, technical analysis, on the other hand, is the process of evaluating the value of the company based on the stock performance of the company on the stock market. It is basically based on the statistical projections. So, this is basically an introduction to the financial analysis. Financial statement analysis is a part of financial analysis. So, financial statement analysis is a part of financial, and it forms the core fundamental analysis. As I already told that financial analysis is of two parts. Financial analysis is of two parts. One part is fundamental analysis, and other is technical analysis. Do both qualitative and quantitative. Quantitative analysis is about evaluating the financial performance of the company, and qualitative analysis is about the management structure, management performance based upon that is a qualitative, and it is not the part of financial statement. A financial statement, it's a summary of financial information given in the form of profit and loss account and balance sheet and in the cash flow statement and equity shareholder statement. This we have studied in the earlier sessions. What are the components of profit and loss account, balance sheet, cash flow statement, equity holder statement. We discussed the components of all these financial statement in the earlier class. And for the purpose of analyzing the financial statement, we'll use different types of tools and techniques which are based on mathematical and statistical tools. So all tools and techniques of finance statement analysis are four categories. One is comparative financial statement analysis, and the second one is common size financial statement analysis. The third one is trend analysis, and the fourth one is ratio analysis. In the comparative analysis, we'll do the comparative analysis of the financial statement year on year. One year after year, we can compare the financial statements of a company. So, and it will give a comparative picture of the performance of the company. In case of common size analysis, we'll do the analysis of financial statement based on based on a standard parameter in the financial statement. So, for example, in profit and loss account, the basis is revenues. Based on the revenues, all expenses has been incurred. We study uh, uh, composition of item in the profit and loss account in relation to the revenues incurred by the company. And at the same time, the composition of assets and liabilities can also be studied in terms of the total assets and total liabilities. So we'll try to understand the change in the composition of financial assets, financial profit and loss account items and balance sheet items on year basis in common size financial statement analysis. The third one is the trend analysis. Trend analysis. Trend. trend, we can loss of content, or we can try to analyze the in the sense how it is moving, whether it is increasing or whether it is decreasing or whether it is stable. And we can also test the relationship of different accounting items like assets and liabilities, revenues and expenses in relation to each other in the trend analysis, so that we can understand how the company is performing with respect to a specific profit and loss item or balance sheet item over a period of time. It will also gives an indication about the how the performance of the company is, how the profitability is, what is the risk of the company. And we can also forecast the future trends based on the information given in the, based on the information generated in the form of trend analysis. And the other one, and the last and important one, is the ratio analysis. Ratio analysis is a ratio analysis is formed based on the mathematical expressions, mathematical expression, and it can be helpful to study the relationship between various balance sheet items and various profit and loss items. That will be helpful to understand the liquidity, and solvency position of the company year on year or for over a period of time. See, let us try to understand how what is a comparative profit and loss. As I already mentioned that comparative financial statements are related to comparison of either profit and loss account items or balance sheet items year on year basis. So here we can see the comparative profit and loss account statement. This comparative profit and loss account statement gives items for 2 years. Say here it can for these 2 years we can compare each item, whether each item has increased or decreased during 2 periods of time. So this right side one gives you the components of income statement and example how comparative analysis can be done. So in 2018, revenue is 2,50,000 and in 2019 it's 3. We can see a change of 50,000 rupees. So in comparison base year 2018, we can see that revenue is 3%. Similarly, we can do for all the items in the profit and loss. This gives you an idea about how each item is each item is incurring by the company with respect to the profit and loss. And the next one, compare balance sheet. It is also similar to profit and loss account. Like in profit and loss account, here also the balance sheet items you can see on the left hand side. So equities and liabilities, non-current liabilities, current liabilities, non-current assets and current assets. So each one can be compared with previous year and current year, and the change can be written on whether each item increased or decreased. Based, we can take a decision whether there is a relationship between assets and liabilities. What kind of liabilities has increased? What kind of assets are increasing? What kind of liabilities are decreased? So we can make a comparative analysis, and this can be done for any 2 periods of time. And this is the comparative financial statement analysis. So next one, format the common profit and loss account. See here in common size profit and loss account, we will take a base item and all the items are measured against. In common size profit and loss account, we will take revenue from operations and all other expenses can be measured against that item as a percentage of that item. So that will give what is the percentage of each expense here. Which expense is increasing, which expense is decreasing in relation to the revenues. Here, for 2021, the revenues are like 5 lakhs and 6,25,000. And this year forms the basis. And against this, we can measure the percentage of all. So we can see the variation in each component for 2 years. So that based on the information, what is the composition of each item, positive trend or negative trend, we can understand using this comparative financial statement. This is common size. This is common size profit and loss. And next one is common size balance sheet. Like in common size problem, here also we will take the base item as total assets or total liability. And each item can be measured again. Each item can be taken as a percentage of total assets or total liability. The left side uh, picture gives you the idea of what are the various components of a balance sheet or in a common size balance sheet. And the right side image gives you the amounts against each component. This is the example you can see. And the percentages can be measured against the total assets and total liability, so that we will understand how they varied year on year based against a base of total assets or total liability. So you can see that share capital was increased from 45% to 50%, and there is no change in the reserves and surplus. And we can see there was an increase in the long-term borrowings. And also we can see that inventories also increased, no change in profit and loss account, and there was a decline in cash and cash equivalents. So based on these parameters, we can understand whether we are making investments or we are doing our operational performance is good or bad. So common size balance sheet will give us an idea with respect to the total composition of balance sheet. And similarly, the common size profit and loss account gives the composition of each item against the total revenues incurred during a period. This can be helpful to make a comparative analysis for 2 years. Let us try to understand some of the benefits and limitations of common size profit and loss account and comparative uh, benefits and limitations of comparative and common size financial statement. So in comparative financial statement, it will help to understand the trends, year on year trends can be understand how each year the changes in the items have been happening, whether in the profit and loss account or whether it is in the balance sheet. So based on that trends, we can set a benchmark. Benchmarks are the standard practices that can be performed against all the industries. So if one company sets a benchmark with respect to performance parameters, that can be considered as a benchmarking performance, and it can be followed by the other companies in the industry. So at the same time, we can do forecasting also based on the information given in the based on the information generated from the comparative financial statement. If we are observing a similar trend or similar changes in all items over a period of time, we can based on that we can make a projections with respect to revenues or with respect to capital expenditures we are going to incur. And this is benefits of the comparative financial statements and the limitations. So one of the limitation of the comparative financial statement is they doesn't provide a broader scope. The scope is very limited. It is only limited to the items in the financial statements only. Other non-qualitative information cannot be considered. And there is an impact of accounting practice. Maybe all companies may not be following the accounting practices. So there may not be a comparability of the information generated from the comparable financial statement. Sometimes there may be incomplete information given in the financial statement also. There are chances that all informations may not be given in the financial statement. So it may be affected by such limitations. And the common size, let us understand the benefits of common size financial statement. It highlights the composition and structure of company's financial structure. See, based on the analysis of common size profit and loss account and common size balance sheet, we can understand the composition of each item in profit and loss account and each item in balance sheet against a standard base, so that it will give how various components are comprised in the whole financial structure of the company. It's based on this information, we can understand any backlogs in the performance or any backlogs in the financial structure of the company. As usual, like comparative financial statement analysis also, this type of common size financial statement analysis also helps you to understand the trends, patterns, and areas of improvement. So whatever the limitations that are applicable to comparative financial statement, similar limitations are also applicable to common size financial statement. There may be some inconsistencies all the time, that is errors may be occurred, and it is related to only one particular period of times. And the data will give numerical information, but it may not always give you right kind of input certain times. So there are chances that some decision making may be distorted based on the alone the financial information given in the financial statement. These are the limitations and benefits of comparative and common size financial statements. Let us understand next the trend analysis. For 1 minute. Everybody is seeing my slides, no? No problem with the slides, right? Everybody is seeing slides, right? Hello? Can someone speak, please? I cannot see the chat.
Yes, sir, we can see the
Okay. Right. Trend analysis. Trend analysis helps to evaluate an organizational financial information for over a period of time. So, like in comparative and common size financial statement analysis, we can see only for a period of 2 years. We cannot go for more than 2 years. But when it comes to trend analysis, we can do this analysis for a period of more than 2 to 3 years or more than 5 years or 20 years. The periods can be, we can measure this trend analysis for a period of, for every month, for a consecutive month or for consecutive quarters or for consecutive years, we can measure the performance. Year on year, we will measure the change in the quantity of one particular item in terms of percentage or in terms of its composition with respect to the specific parameters. This trend analysis can help to compare two companies over a period of long time, say for more than 3 years or 4 years. Based on the information generated in the form of trend analysis, we can understand how the company is performing with respect to fulfilling its short-term solvency and long-term solvency over a period of time. So, as how the comparative financial statement analysis is affected, similarly, trend analysis will also be affected by the accounting policies and changes. This trend analysis is sometimes affected by the price level changes. So, we are going to take data for a long period of time, say for example, 10 years or 5 years. So, all these years, that price value may not remain, money value may not remain similar. So, in this case, the trend analysis sometimes may become irrelevant, and when there is a economic disturbance or there is high level of inflation in any particular year. So, there was a need to make certain adjustments to the inflation prevailing in the market. See, this was an example. You can see that for over a period of time, we can see that income operating. So for all these years, we can see a graph has been plotted and we can observe how they are growing. So from 2007, 8, 9, and 10, 11, you can see there was no much difference between total income, expenditure, and operating profit. So, but you can see over a period of time, there was an increase in the total income and total expenditure, and simultaneously we can see an increase in the profit also. So, likewise, trend analysis can be performed for a specific item, for a specific individual item, or it can be performed for a different item to see the relationship between different items in the profit and loss account or balance sheet for a long period of time in terms of percentages or in terms of ratios. This is the form of trend analysis. This is the third category of tool and technique that is used to analyze the financial statement of a company. So these are the three basic techniques that we will use in analysis of financial statement. One is comparative financial statement, the other one is common size financial statement, and the other one is trend analysis. These are basically related to one specific two are related to specific period of time, and the other one is related to a long period of time. But we cannot do any cross analysis in these three techniques. We can only look at the absolute number, and we can only make a direct observation with respect to the relations, but we cannot make any meaningful information by doing cross-sectional analysis. Cross-sectional analysis means we can compare a balance sheet item with a profit and loss account item, or a profit and loss account item with a balance sheet item. So such type of analysis is not possible in the comparative analysis or common size analysis or trend analysis. So to overcome this problem, the other technique that we commonly used and the most important tool is the ratio analysis. So we are going to cover about this section and this part, we are going to cover about the third tool and technique, ratio analysis. Very important and very useful tool in analyzing the financial statements of a company. So we'll see about what is a ratio analysis. So what is a ratio? Before we are discussing about, we need to understand what is meant by a ratio. A ratio is a mathematical expression that will help to find relationship, but will help to understand the composition of any two related items, which can be expressed in the form of a fraction. Fraction means how two items are related to each other. What is the composition of each item with respect to a specific measure or specific item? So that can be expressed in the form of a fraction, or it can be a proportion. Proportion means percentages, and how 1% is more than other person. So this type of ratio analysis can be done when any two items are related to each other, when two items are affected by each other. So the performance of one item may affect the other item. So in such type of cases, we can define a ratio for these items. So simply, if you same thing for the financial accounting elements. The financial accounting elements are revenues, expenses, assets, and liabilities. So when we are able to create relationship between a different type of revenues, different type of expenses, and different type of assets and liabilities, we can understand how each of them were affected by the performance of other items. So this we cannot understand by looking at the financial statement. So when we have to look into deeper into the financial statement, we need to look into each component separate. So in that case, to analyze the performance of financial performance, to analyze the performance of the company, ratio analysis will give you a micro inputs into the financial statement. So in the case of ratio analysis, we can group different assets and liabilities together. We can group different revenues together. We can group different expenses together to understand the performance of the company. It provides the crucial information and point out where there are chances that need to be taken action, where there are discrepancies in the performance of the company, where there are discrepancies in the financial structure of the company, where there are problems with the solvency of the company. So all these companies need to be, all these issues can be understood using the ratio analysis. So for performing the ratio analysis, a thorough understanding of the rules and regulations that are used in the financial statements is essential. So as already said that the ratio analysis will help you to identify the areas which need to be focused more upon, whether we have to increase the revenues, or whether we have to decrease the expenses, or whether we have to reduce the composition of assets, or whether we have to reduce the composition of liabilities, how with relation to liabilities can be arranged. So all this information can be provided using the ratio analysis. So use a direction to take better decision making, provides insights about the profitability, liquidity, and solvency. To provide information from the financial statement, useful for making projections and estimates for the future. So based on the information generated from the ratio analysis, we can able to make future estimates also with respect to specific items. Though comparative financial statements and common size financial statements, trend analysis also will help. But determining accuracy in terms of other tools is less when compared to ratio analysis. Using ratio analysis make better projections than the other tools. So how we can also understand how operating, investing, and financial, as already told, operating decisions are related to revenue generation and incurring of expenses. Investing activities are related to where the company has to invest. Financial decisions are related to where the sources of revenues, income, sources of money can be generated. And this ratio analysis will help to solve the complex financial figures into simple ratios, so that we can understand the performance of the company. Ratio analysis also helps to create trends, different trends we can make a comparative between different companies across the industry. When the ratios, when information generated in the form of ratios simplifies, this will make a better picture about the company, and it can help to make better comparison with other companies, and it will also helps to make better benchmarks. But the same thing can be done by other tools also. But in ratio analysis, we can make better outputs. And limitations of the ratio analysis. So as all the financial statements are subject to bias, that means different accounting policies and practices will be followed by the company. So this will because of that, the ratio analysis may not sometimes be accurate. There may be some types of unreliability in the ratio analysis due to subjectivity in the ratio. So money values can be reflected as we already discussed. So there is the effect some ratios that were generated based on the historical cost may not give better current picture of the company. This will takes only quantitative information into consideration. They won't take any non-quantitative information into consideration. So as already discussed, that variations in the accounting policies and changes will also affect the process of ratio analysis. So this is briefly about ratio analysis, and next let us discuss about different ratios that are used to analyze long-term solvency, short-term solvency, and effectiveness of the company. How we can understand all these components using ratio analysis. First is profitability. Profitability is how much the business is worth, how much it was able to generate incomes out of its operations and out of the funds it was invested in the company. What are how much of net profits the company is generating using the funds? Funds means the long-term sources of funds like share capital and long-term liabilities. So we will try to understand the performance of the company with respect using the profitability ratio. So basically, profitability ratios are gross profit ratio, operating profit ratio, and a net profit ratio, return on investment or return on capital employed, return on net worth, earnings per share, book value per share, dividend payout ratio. All these ratios will give the performance of the company with respect to profitability. Profitability in the sense whether it was able to generate considerable revenues or not based on its operational data and the sources of investments. Let us understand each ratio individually. So gross profit is generated from the by deducting manufacturing expenses from the revenues. So it is really manufacturing expenses from the revenue. So this ratio is calculated as a percentage of gross profit against the revenues. We'll get gross profit by subtracting revenues from the by subtracting net revenues from the manufacturing expenses. That gross profit can be calculated as a percentage of net revenue. So this percentage should be higher so that it will indicate that expenses are lower and the revenues are better. And this is briefly this is about the gross profit ratio. It gives an idea about the operational performance at the manufacturing level. And the operating ratio. Operating ratio is about the a percentage of expenses that were incurred in performing the overall operations of the company, whether it is manufacturing or whether it is the operations at the office level. So that operation expenses includes that administrative expenses, office expenses, selling expenses, distribution and depreciation expenses. So the total of all these expenses can be calculated as a percentage of net revenues. So this percentage also should be lower in comparison with the net revenues. If this is higher in composition with the net revenues, then there is a problem with respect to the operational performance of the company. Automatically, that operational profit will be reduced. So this is about operating ratios of the company. And the next one is operating profit ratio. What is operating profit ratio? Now we calculated the operating expenses. Operating expenses are the total expenses incurred by the company during a financial year, and we calculated the percentage of that expenses with respect to the revenue generated from the operation. Then what is an operating profit? The operating profit is a refined one, then gross profit. In gross profit, we will only exclude the manufacturing expenses. But in operating profit, along with the manufacturing expenses, we will also exclude operating expenses of the company. And the net that the net amount can be calculated as a percentage of revenue from operation. This gives the percentage of operating profit. That is the amount that was generated from the operations of the company is the operating profit ratio. So this gross profit, in comparison with gross profit, this operating profit will be lower, but it should not be much lower. When it is much lower, then the operating expenses are more. So the objective should be to reduce the operating expenses so that the operating profit will be increased. So there should be an inverse relationship between operating ratio and operating profit ratio. If that ratio increases, the profit will come down. If the ratio is decreasing, this profit ratio will be increasing. The other profitability ratio is the net profit ratio. How we will calculate net profit? Net profit is calculated by deducting tax from the operating profit. So this operating profit excludes all the manufacturing expenses and operating expenses from the revenue. Then we will calculate an operating profit. After that, we will calculate net profit ratio by deducting the tax from the net profit. So that net profit gives you the better picture of all the operating profit ratios so far we have calculated. This gives the net performance of the company. It should always be higher so that it will indicate the efficiency and operational performance of the company. Based on the net profit ratio, better operational performance of the company. Next one is return on investment or return on capital employed. So net profit, return on investment and return on capital employed. This is capital employed is the amount of total capital that company has generated from the shareholders and the outside liabilities. So this is the investment that we generated from the outside, and out of this investment, how much amount we got as a return. That is calculated as based on the net profit generated before tax and before interest. That amount can be taken as for the calculation of return EBIT, earnings before interest and taxes can be taken because we have to exclude the interest component because we are measuring the performance of the company based on the outside shareholders also. So before that interest is paid to the outside shareholders. So before the interest is paid, we have to measure the efficiency. So the return on investments can be calculated based on the earnings before interest and tax on the total capital employed. Total capital employed is nothing but share capital plus outside liability other than current liability. Return on shareholders fund. So for calculating return on shareholders fund, so it's very clear here. Shareholder funds is nothing but the funds contributed by the shareholders in the form of share capital, reserves and surplus, and any other application or premium money can be included in the shareholder fund. The profit that is calculated after the tax is taken as a component of calculating return on shareholders fund. The percentage of profit after tax on the shareholders fund gives you the amount of return that actual shareholders of the company can be received during a year. This should be higher. It should not lower. The performance can be considered when it is high. The performance can be considered good when it is higher, and it is considered to be bad. It is considered to be varying when it is looking lower over a period of time. And another parameter that will help to understand the profitability or the efficiency, operational performance of the company is based on the earnings per share. Normally, as a shareholders, we will purchase shares. So, for example, a person purchases 1,000 shares. The market value or the face value of the shares can be rupees 10 rupees, or the market value can be some other price like 100 rupees like that. So he is holding some amount of shares in hand, and we calculated profit after tax. After obtaining profit after tax, we can see that anything can be paid to the preference shareholders. So after payment to the preference shareholders, the equity shareholders will left with certain amount that is going to be their percentage of share in the profits. So that for the number of shares held by the company, what is the price that he is going to get? See, for example, if the company, after paying all the taxes, after paying all the preference shareholders, say for example gets some 1 lakh rupees, and 1 lakh rupees as the profit available to the equity shareholders. So, and one person is holding 1,000 shares, then we can say that he is earning 100 rupees per share. His earnings may be 100 rupees per share for that particular year. This is about earnings per share. Earnings per share also should be standard, and it should be higher in comparison with the market performance of the stock. Book value, on the other hand, is we'll take value of the equity shareholders that are given in the balance sheet. The balance sheet figures will be taken into consideration, and they will be divided by the number of shares. So this earnings per share and book value per share, book value per share gives what is the actual value of the share based on the fundamentals of the company. And the dividend payout ratio. This refers to the proportion of earnings that are distributed to the shareholders. See, earnings per share gives you that what is the amount of earnings a person earned from the profits, but that all amounts cannot be paid to the shareholders. Only certain amounts will be paid to the shareholders, and what amount they are going to pay is called as the dividend. So that dividend, how much? See, for example, in the above example, we said that for 1,000 shares, he earned an earning per share of 100 rupees. Out of that, he may be paid some 50 rupees. So that 50 rupees is the dividend. So that 50 rupees divided by earnings per share will give you the dividend payout ratio. How much of the amount of profits you are getting as a share of dividends is called as the dividend payout ratio. And price to earnings ratio. Price to earnings ratio is a market-based parameter. See, earnings per share, we earned 100 rupees per 1,000 shares. So the book value may be, for example, some 50 rupees, and earning per share is 100 rupees. So the market price may be some 150 rupees. So when we compare these three, we can see that when we are earning 100 rupees per share, and when your market price of that share is 150 rupees, it gives the relationship between how much your share is performing in the market based on the earnings capacity. So based on that, we can understand whether the company's market performance is good or bad, whether it is overperforming or underperforming in comparison with the book value. See here, book value, we are considering it as 50 rupees, and market value is 150 rupees, and earning per share is 100 rupees. When we make these three in comparison, we can see that market performance of the company is good. Considering its base value, it is trading better based on the earnings per share, based on the book value of the company. So based on these 8-10 ratios, we can measure the profitability or operational efficiency of the company. This is about the profitability ratios. How much of the company based on the revenues and based on the investments based on the sources of investments the company has raised, and how it is creating value to the shareholders. This performance can be analyzed using these 10 ratios. And next, the other ratios are activity ratios. Activity ratios indicates the performance, how the activities of the business are going on, whether they are performing actively, and that means day-to-day activity, or there is any discrepancy in performing the day-to-day activity. The performance of day-to-day activities can be understood using the turnover ratios. These ratios, these ratios helps to understand how the sales are generating. What is the uh, uh, what is the revenue? What is the revenue generation capacity of the company during a year? So it will help to understand the operation liquidity and operational performance of the company. Let us understand each ratio. Inventory turnover ratio. So inventory turnover ratio can be calculated based as a component of revenue generated from the operation. See, in comparison with the revenue generated, uh, how many times the how many in comparison with revenue in comparison with generation, we can understand how many times the revenue has been how many times the inventory has been rotating. See, for example, revenue from operations is 1 lakh and the inventory staying with the company is 10,000. So now the inventory turnover ratio is 10 times. That means considering the base value of 10,000, we can understand that stock has been rotating more than 10 times during a year. So this will use the performance of the company. With more accuracy, with more speed, the inventories are rotating. Rotation means we are purchasing the inventory. You are having 10,000 rupees and your sales are 1 lakh rupees. That means you're purchasing 10,000, you're maintaining this 10,000 of stock 10 times during a year. Every time 10,000 rupees of stock is generating. That means 10 times during the year your stock has been rotating. When it is lower, for example, if average inventory lying with the company is 50,000, then what will happen? It will comes to 5 times. That means the speed of revenue generation will be lower. So based on what it will give is that your manufacturing capacity is going well and your revenues are also performing well. So this inventory turnover ratio should always be higher so that it will indicate your operational performance, your activities are performing in a quicker way. Trade receivables. Trade receivables are nothing but the amount that we have to receive, that we need to be received from the debtors who are our customers. These trade debtors are also calculated as a component of revenue from operation. This will indicate how many times they are paying back our money. So for example, if your revenues are 1 lakh rupees and your trade receivables are 20,000, for example, this will use that 5 times during a year at the quantity of 20,000. Every time 20,000 we are receiving from the actual sales. From out of 1 lakh rupees sales, every time we are receiving 20,000, like that. Every 5 times during the year, we are getting back your receivables to the company. Similarly, payables. How much we are paying? Payment is considered based on the credit purchase. See, for example, how many times we are purchasing during the year. It is depend upon how we are paying now. So, for example, uh, during the year we purchased 1 lakh. We have a credit purchase of 1 lakh rupees, and we are paying 20,000 every time. So that gives during a year 5 times we are paying our payables. Out of the credit purchases we are doing, 1 lakh credit purchases we are doing, we are purchasing 20,000 as a 20,000 5 times during a year. So this should be lower. Lower indicates that is based upon the relationship between, we have a relationship with the supplier, and this ratio can be lower, but it always should not be much delay in the payments also. Payments also should be made in a quick span of time. And the investment turnover ratio. So investment turnover ratio is what is the amount of revenues that were generated based on the capital employed. How many times the revenues are generated out of capital employed? Capital employed is the amount of investment that was made by the shareholders and the outside creditors. So, see, for example, the outside investment and the shareholder investors are considered to be 2 lakhs rupees, and revenue from operations is 1 lakh. See, out of the investments, how much percentage we are generating? We are generating 50% of the revenues from the capital invested. So this will give an indication about that how much the capital is efficiently utilized. Similarly, the same thing can be measured with respect to fixed assets and with respect to working capital. So this will use you the efficiency of revenue generation by utilizing your funds in the form of capital, in the form of your investments. Investments in the fixed assets. Always this should be a positive sign. It should be higher. This ratio should be higher. So this will indicate that you're performing better with respect to the amount that you are incurring and with respect to the investments that you are making. This will indicate how efficiently you are utilizing the funds given to the company. This is basically about the turnover ratios of the this turnover ratios or activity ratios of the company. And the other measure is the liquidity. Liquidity is about how we were able to meet the short-term obligations of the company. Short-term obligations are current liabilities of the company. So the current liabilities are those which are incurred in the regular operational activities of the company. So you need to follow a specific time period of time so that we can settle the all the current liabilities during a period of 1 year. So this will indicate your if you are not unable to meet your short-term obligations, short-term requirements, you are not unable to pay the short-term obligations, then you are at a danger. So to understand whether we are doing whether our liquidity, that means whether our operational capability in terms of payments is good or not, we have to understand the liquidity performance of the company using liquidity ratios. The liquidity ratios are calculated using current assets and current liability. The first ratio helps you to understand the composition of current assets with respect to current liability. So, current assets includes we have to make investments for regularly running the business activities. We have to make investments in the current assets, and those current assets includes investments like inventories, trade receivables, cash and cash equivalents, short-term loans and advances. These are all current assets which can be generated into the cash within a period of 1 year. Using these current investments, you should be able to pay your short-term obligations within a period of 1 year. That is current liabilities. Current liabilities normally include short-term borrowings, trade payables, and other short-term provisions. So the current ratio should always be positive in comparison with current assets and current liability. It should not be too higher or it should not be too lower. Too higher indicates that you are not properly utilizing the cash resources or idle cash resources or cash equivalents. If it is lower, then it is an indication that we are unable to pay any short-term obligations. See, let us try to understand one example here. Earlier, we studied about accounts payable period. During 1 year period, the payables can be done 5 times or 6 times. So that flow should be. So based on the current account ratio, we can understand that flow can be maintained during a period of time, during a period of 1 year or more. This will use an image about liquidity position of the company during a period of 1 year. And quick ratio. Quick ratio is a bit refined version of the current ratio. While calculating the quick ratio, we will exclude some less liquid assets like prepaid expenses and advanced taxes. So this will give a better picture of the position of the company in the short. This ratio will be better better and sharp in comparison with the current ratio. It will give the accuracy with which you can pay the current liabilities in a short span of time when compared to quick ratio. These are the two important ratios that will help to understand the short-term solvency of the company. And now the one is solvency ratios. What are solvency ratios? See, we know that we are going to get money from the outsiders. Who are outsiders? Shareholders and other outsider liabilities. So when they give money to us, they are interested to know whether we were able to pay their amount back or not. So they have to know their risk capability within the company. So if you want to understand what is the risk capacity that a person can take within the company, we have to use the solvency ratios. Solvency ratios will help you to understand the solvency position of the company in the long run. The long run solvency position of the company can be understood by using solvency ratios. These are 5 solvency ratios that will help to give you an image about the solvency position of the company in the long run. Debt to equity. Debt to equity ratio gives you the composition of, we can say that, let us understand the difference between equity and debt. Equity shareholders will not get a guaranteed payment, while the debt people will have to, if you are taking a debt, we have to pay the interest on the debt regularly, but shareholders will not be paid. So by calculating the composition of debt in equity, we can understand what is the composition of debt in equity. If it is higher, then there is a risk for for those who are giving the debt. If it is lower, then there are chances there is less risk for the debt holder. So normally it is maintained equally, but it should not be more in comparison with the shareholders. Though it gives a advantage in terms of uh, leverage, higher ratio will be riskier all the time. This is direct. This will give you a direct view about what is the composition of debt to the equity. And another one, debt to the capital employed ratio. So earlier we measured the composition of debt with respect to equity. Now we will measure the composition of debt with respect to all the outside liabilities. How the analysis and interpretation of this ratio is also similar to like that of debt equity ratio. The composition of debt should be lower in the overall capital structure. Higher debt will increases the risk composition for the company and for the outsiders also. They can consider that composition, the higher composition is there, the payment of interest may be riskier for the company. So therefore, this ratio should be always moderately be managed. Okay. See, you understand one point here. Shareholders' funds or shareholder share capital, reserves and surplus, and money received against share warrants, like this. And capital employed means shareholders' funds plus outsiders' funds also. That means outside liabilities, debt obligations can also be considered under capital employed. And the next one is, this is debt capital. Proprietary ratio. Proprietary ratio gives you the composition of shareholders' funds in the total capital employed. This is the reverse of debt to capital. This is the reverse of. This is a not reverse. This is the extension for debt to capital employed ratio. Here we are calculating the composition of debt to the total capital employed. Here we are calculating the composition of shareholders in the capital employed. Capital employed is nothing but shareholders' funds and outsider funds. Here also the shareholder funds should have a minimum composition. It should be maintained moderately. Higher proposition of higher proposition will give more risk for the equity shareholders, but for the outsider shareholders it will be less. If more burden will be bear by the equity shareholders. And the last one is the total assets to debt ratio. Total assets to debt ratio will give you an understanding about how much of the assets are financed from the long-term debt. Long-term debt. So most of the total assets should be financed from the shareholders' fund. When you are financing from long-term liabilities, it is a riskier for the company. More long-term debt gives because all assets cannot be realized in a short period of time. They will be held in the company for a long period of time. Hence, they should be financed from the cheaper sources of finance. See, shareholders' funds are very cheaper. We need not pay regular payments, but long-term debts will be higher. So the composition of total assets in comparison with the long-term debts should be lower. So that should be higher. So that what will be understand is we are not financing the assets from alone long-term liabilities. So they are financing from the other less sources also. So this will give an indication that the company will be strong in its payment of outside liabilities or shareholder obligations in a short period of time. Interest coverage ratio. we discussed about the debt equity ratio. In the debt equity ratio or debt to capital employed ratio, we try to understand what is the composition of debt in the equity share capital or in the total capital structure of the company. So when it is higher, the payment of interest obligations will also be higher. So whether the company was able to pay the interest obligations of the company, interest obligations of the debt holder, that can be understood by using the interest coverage ratio. The interest coverage ratio can be calculated. Interest coverage ratio can be calculated on net profit before interest and taxes, and how much amount of interest we have to pay for the debt holder. So, for example, every year we have an obligation to pay 20,000 rupees as interest to the debt holders, and if the net profit is 1 lakh, net profit before interest and taxes is 1 lakh rupees, then we can say that the net profit is 5 times more than what we have to pay to the long-term outside liability holder. So this is a good indication. So the higher the interest coverage ratio, higher will be the safety for the long-term outside liability, outside creditors, outside fund providers, other than share capital, other than shareholders. So this is about different types of ratios and what is the usefulness of each ratio and how each ratio is helpful to understand the profitability, operational performance, long-term solvency, and short-term solvency of the company. See, to do this analysis, we need to have an understanding about different components of profit and loss account and balance sheet. So, in profit and loss account, we will have a revenue, and on the left-hand side, we will have all the expenses. So, it's very simple to understand the components of a profit and loss account. When it comes to balance sheet, it is a bit of confusion. So we should have a thorough understanding about what are current assets, what are current liabilities, what are non-current assets, what are current assets, what are shareholders' funds, what are non-current liabilities, or what are current liabilities. So if we have an understanding about these items, we can make ratio analysis easily. Otherwise, the process of ratio analysis will be complicated, and how the formulas can be used will be difficult, because we can design your own formula also. If you understand the relationship between each item in the profit and loss account and balance sheet, accordingly we can do our own analysis. We can also formulate new ratios also based upon establishing a relationship between each balance sheet item or each profit and loss account item. So let us have an understanding about these components. So now we will discuss one problem. Last week, some of you have asked about some problem. I was sent to some problem. So I will try to discuss that problem which was sent to me last week. Some of them also solved and sent to me. So once again, I will discuss the problem. I'm not going to discuss the same problem that was sent to me because it is an assignment problem. Same problem, but with different numbers, I will explain to you how we can solve that problem, so that you will have an understanding about how to use the ratio analysis. Everybody understood now so far? I will share the PPTs, don't worry. I will share you the PPTs. Here in chat box, it can be shared. I don't know how to share. If you share it, I can share here. Okay? I will share you the PPTs, no problem with that. So can I go with the problem now? Can I go with the problem? Ratio analysis problem? I will share you the problem. One minute, I'm sharing the PPTs in the chat box. Okay. Yeah, I got it. I got it. I'm sharing it. Okay. I'm sending that PPT. You can take that PPT. Okay. So shall we go with the problem now? We have half an hour time. We will have a okay, right. Can you see my? Can you see the problem now? Yeah. Okay. See, this is the problem that was sent to me last week. It is about how to prepare a profit and loss account and summarize the balance sheet uh, based on some information given for some information given based on the ratios. So we were given current ratio, we were given quick ratio, we were given proprietary ratio, and gross profit, debtors velocity, sales ratio, working capital ratio, bank overdraft, net profit as a percentage of proprietary funds, and closing stock as a percentage of opening stock. So based on the information, we have to identify various balance sheet items. We have to identify various balance sheet items and profit and loss item, and we have to prepare a profit and loss account and balance sheet. Okay. See, from current ratio, we can see that current ratio is the percentage of current assets to current liabilities. It was given as 2.5, and using this ratio, we can tell that current ratios are equal to 2.5 times of current liability, because we can send these current liabilities to that side, so that current liabilities can be equal to 2.5 times of current liability. This is one equation we have derived from the given information. On the other hand, we were given that working capital as 2,40,000. The formula for working capital is current assets minus current liabilities. We know that. So current assets minus current liabilities is equal to 2,40,000. From the current asset ratio, we derived that current assets equal to 2.5 times of current liability. 2.5 times of current liability. So when we put this 2.5 times of current liabilities into working capital formula, we can say that 2.5 current liabilities minus current liabilities is equal to 2,40,000. That implies that by subtracting 2.5 times current liabilities from current liabilities, we will get that 1.5 times of current liabilities is equal to 2,40,000. Therefore, current liabilities is equal to 2,40,000 by 1.5. That means current liabilities is equal to 1,60,000. 1,60,000. Now, by putting this 1,60,000 current liabilities in the current ratio, we will get the value of current assets also. What is current assets we are showing here? We are showing here it as current assets is equal to 2.5 times of current liability. By using working capital formula, we got current liabilities as 1,60,000 rupees. If you put this 1,60,000 here, 2.5 times of current liabilities is equal to current assets. Therefore, current assets is equal to 4 lakhs. Current liabilities is equal to 1,60,000. Okay. And here you have to understand one more point. We were given that overdraft as 30,000. So, overdraft is a current liability. Overdraft is a current liability in the balance sheet. Out of this 1,60,000, we have a bank overdraft of 30,000. So, if you deduct that 30,000, we can consider the remaining amount as creditors. So now, current divided into creditors and overdraft. Therefore, the total current liabilities will be 1,60,000, and the current assets will be 4 lakh. So this is what we can derive from the working note 1. From working note 1, we calculated current assets value, current liabilities value, and current liabilities were further subdivided into sundry creditors and bank overdraft. Then, then we have to calculate the inventory. We have the scope to calculate inventory. How we can calculate the inventory? The quick ratio gives you the formula of current assets minus inventory divided by current liabilities is equal to 1.3. Okay. So we know current assets 4 lakh, current liabilities 1,60,000. If you put that values into this equation, we can say that inventory can be calculated as 4 lakhs minus inventory can be calculated as uh, by uh, by multiplying liabilities with 1.3, we'll get 2,08,000. And after subtracting this 2,08,000 from these 4 lakhs of current assets, we will get inventory 1,92,000 as the closing stock. Okay. So from this, we calculated the closing stock inventory using current assets and current liabilities values we derived from the above formula. Now, by using the closing stock information, we have to calculate the opening stock information. We have the scope to calculate the opening stock information also. In the problem, we were given that closing stock is the 10% more than opening stock. So closing stock is 10% more than opening stock. That means closing stock is equal to opening stock plus 10% more than the opening stock. Okay. So 10% more than the opening stock. That is equal to how much? We already calculated that closing stock equal to 1,92,000, and it is equal to 10% more than the opening stock. Therefore, we can write this as opening stock equal to 1,92,000 into 100 by 110. Because it is more than 10%, that closing stock is more than 10%, we have to divide it by more than 100%, and we have to multiply it with 100, so that it will give the opening stock value. So opening stock, the cost of opening stock is that rupees 1,74,545 is the opening stock value. Now we got the value of opening stock and the closing stock. Next, what we have to do is we got total current assets. We have got total current assets. Out of that current assets, so far we calculated one component, inventory, closing stock, 1,92,000. So we have chances of finding the other components also. As we have given the information of that debtors turnover period is 40 days. That means we have given an average collection period. That is, how we will get the average collection period is number of days, or we can calculate it for average collection period can be for a period of, in the case, it can be in terms of months, or it can be in the form of days. We were given in the form of days. So average collection period, based on this information, we can calculate the turnover, trade receivable turnover ratio. That means how many times they are paying. For here they were given as 40 days, and in a year there are 365 days. Accordingly, for like that, we'll have 40 days 9 times in a year. 9 times in a year. So the turnover ratio can be 9 times. Now, using this average collection period and the formula for average collection period, we were able to calculate the turnover ratio. And now, using this turnover ratio, we can calculate net credit revenue from operations and divided by average trade receivables. So we wanted to measure now we are measuring trade receivables. How much we have the trade receivables. So using average collection period formula, we were able to calculate the turnover ratio. Turnover ratio is 9 times, and net revenue from operation, that is sales. Sales amount was given in the problem again. How much it was given? It was given as 14,60,000. So average trade receivable turnover is 9 times, and the sales turnover is 14,60,000. So by using this formula, now we can calculate that trade receivables as rupees 1,62,222 rupees. Now the trade receivables we got as 1,62,222 rupees is the trade receivable. Now let us understand. See, I'm going a bit fast. You can also, after completing the problem, if you have having any doubts, you can ask. Okay? Now see, here we got current assets. Current assets cost is 4 lakhs. So out of this 4 lakhs, we already calculated the closing stock value. That is 1,92,000 is the closing stock value. Now we calculated debtors value. 1,62,222 is the value of debtors. See, from this current assets, we can deduct this current assets are a composition of debtors and closing stock. After deducting these debtors and closing stock, we got 45,778 as a balancing figure. This we can consider this balancing figure as a cash component. Now that we can see that current assets can be further subdivided into three categories. One is debtors, one is closing stock, and another one is the cash component. So three components can be considered on the current assets. We already identified components of current liabilities. Now we identified the components of current assets. Now, two important components that we have to find out is what are the proprietary funds. Proprietary funds are the shareholder funds. Proprietary funds are the shareholders' funds, and fixed assets. What are the fixed assets of the company? And we have to find out the net profit of the company. So this is a little bit confusing and it's a little bit complicated to understand this area. See, we were given that fixed assets to proprietary funds as 6.0. 6.0. See, before we are discussing this, let us understand that we will have an understanding about this balance sheet. See, when we are considering only shareholders' fund, we can tell them as proprietary funds. Or when we are taking shareholders' funds along with current liabilities, we can tell them as capital employed. So, also what we can tell is this non-current assets plus current assets minus this current. You see, here asset side we have current assets and non-current assets. When we add these current assets and if we subtract these current liabilities from these current assets, we will get shareholder funds along with non-current liabilities, right? Or here you have to understand one more thing also. Current assets plus non-current assets plus current assets minus current liabilities. Okay, non-current assets plus current assets minus current liability. See, you see one thing I will show you. Non-current assets plus current assets minus current liabilities is equal to shareholders funds plus outside liabilities, right? We can take these two. Non-current assets plus current assets minus current liabilities is equal to this component, right? So you observe one point here. If you consider these two things, can we say this as a working capital? So this can be considered as a working capital. So further, this can be defined as non-current asset. Non-current assets also means fixed assets. Plus these two current assets minus current liabilities, we can consider them as working capital. Plus shareholders funds plus outside liabilities, outside liabilities. So we did not give any outside liabilities in the problem. In the problem, we don't have any long-term liabilities or long-term obligations the company need to be fulfilled. So this component can be zero. Therefore, non-current assets, that means fixed assets less working capital is equal to shareholders funds or we are ignoring the outside line, or the proprietary funds given in the problem. Proprietary funds given in the problem. Okay. So we can say that now fixed assets plus working capital is equal to proprietary funds. is equal to proprietary funds, right? And we were given that fixed assets by proprietary funds is equal to 0.4%. That means the composition of fixed assets in proprietary funds is 0.4. It is given as 0.6 in the problem. 0.6%. 0.6%. If fixed assets composition is 0.6% in proprietary funds, then what will be the composition of working capital? Working capital will obviously be equal to the balance is working capital, right? Therefore, 1 minus 0.4. That is equal to, sorry, 0.6. That is equal to 0.4. 4 is the composition of working capital to proprietary fund. Composition of working capital, that is working capital divided by proprietary funds, is equal to 0.4, right? And now in the problem, we have given the working capital. What is the working capital given in the problem? Let us see what is the amount of working capital given. The amount of working capital given in the problem is given as how much? Working capital. Working capital is 2,40,000. You can see it was given as 2,40,000 in the problem. Okay, so 2,40,000. We can multiply this working. We can divide this working capital by 0. Now to get the proprietary funds is equal to working capital divided by 0.4. That is equal to rupees 2,40,000 divided by 0.4. That is equal to rupees 6 lakhs is the proprietary funds now. This is how we got 6 lakhs of proprietary funds. This is how we got proprietary funds as lakh. So now we got the proprietary fund. So this is how we calculated the proprietary funds from the given information. So this is the logic we have to follow. This is the logic we have to follow. This is the relationship we have to understand between the balance sheet items. So we should keep these points in mind before you are understanding this problem. This is only specific to this problem. All problems cannot be same. There are direct, we will get a direct problem as we got some assignment problem. Just I am discussing this problem. Most of the problems will be direct. This is an indirect problem and this will help to make projections for the future. Okay. So now that we have to calculate another component. So automatically we know that fixed assets component, it was given in the problem as 60%. So out of this 6 lakhs, 2,40,000 is working capital composition and the remaining is fixed assets. That is 3,60,000 is the fixed assets component. And in the problem, it was given that net profit is as 10% of the proprietary funds. That is 6 lakhs into 10%. Proprietary funds we calculated and net profit we can calculate as 10% of the proprietary funds. That is 60,000 rupees. So now that we calculated current assets, current liabilities, opening stock and closing stock, and the different components of current assets and current liabilities, we calculated fixed assets, we calculated the amount of proprietary funds, we calculated net profit also. So now just prepare the pro forma profit and loss account. So we already given sales figure, that is 14,60,000, and we calculated the opening stock and closing stock. We can refer to working note 2. From there we got closing stock value. We calculated opening stock by basing on the opening stock, closing stock value, and gross profit value was given in the problem as 10% of the revenues. Here we have sales as 14,60,000. Out of this, 10% is 1,46,000. So the balancing figure will be here purchases, automatically the purchases. So with this trading account is completed, and we can carry forward this gross profit to profit and loss account. In the profit and loss account, net profit is given as 60% of the, 10% of the proprietary funds, that is 60,000. And the balancing figure here will be automatically the operating expenses. So with this we can prepare like this. We can prepare a profit and loss account based on the information. And let us come to how we can prepare the balance sheet of the balance sheet of the balance sheet. Now, from whatever we derived, whatever the information we derived, how we can calculate the balance. See, working note 5, we calculated fixed assets as 3,60,000. We're basing on the formula given, that is fixed assets to proprietary ratio as 60%, and by considering mechanics of ratio analysis, we were able to derive the value of fixed assets and value of proprietary funds from the information based on the fixed assets to proprietary funds. So proprietary funds or share capital value is 6 lakhs. Out of that, 3,60,000 is the fixed assets composition, and the remaining is working capital. Based on this information, we calculate. Okay. And current assets, we calculated the current assets as 4 lakhs rupees. And based on the working note 2, we calculated the closing stock value. And based on the debtors velocity ratio in working note 4, we calculated the value of debtors and the balancing figure cash as 45,788. So with this, the assets component can be done. And current liability. Let us look at the current liability. We calculated current liabilities using working capital ratio and current ratio. We calculated the working capital information given in the formula, working capital information given in the problem, and current ratio. We calculated the value of current liability. And we given bank overdraft as one of the current liabilities. So after considering bank overdraft as one of the current liabilities, we consider creditors as the another liability. So we place that as 1,30,000 and 30,000 in the liabilities. So with the given information in the problem, current ratio, quick ratio, and proprietary ratio, and other important information, we have performed these calculations using mechanics of ratio analysis. We have to say it as mechanics of ratio analysis. Based on the mechanics of ratio analysis, we were able to derive different components of profit and loss account and balance sheet, and we were able to come up with a profit and loss account, and we were able to come up with a balance sheet here. So here the only thing is this is the critical component. Proprietary ratio, whatever they were given in the problem, is a critical component. So this you need to understand a little bit to solve this problem. Okay, everybody has understood the problem. It's a bit a difficult problem. I cannot say it's an easy problem. Understanding in a short period of half an hour is a bit difficult, but this is the process of doing this problem. Because somebody asked me last week, I was able to discuss this. So you have any doubts regarding this problem or regarding any ratios? Or I already shared that PPT in the chat box. Hello. Any other doubts or everything is okay? Thank you, sir. Thank you. Shall we close the session now? Yeah. Right. Thank you, everybody. Thank you so much. Tomorrow we will discuss about cash flow and fund flow statement, right? I'll try to discuss problems related to cash flow and fund flow also tomorrow. Most probably we'll try to complete everything, right? All the best. Take care. Bye-bye. Thank you. Thank you so much.